Hey guys, your agent Tyler Wehrung here with Keller Williams, and today we're going to talk about two common approaches to tap into the equity in your home. We get questions about this all the time, but the two common approaches are the cash out refinance and the HELOC. So we'll jump into all the things you need to know with each one of these. Well, with that, let's jump in. All right, guys, so a cash out refinance or a HELOC can be very powerful tools depending on what your goals are. So we're going to talk about kind of the approaches with each one of these. We'll walk through an example here with a $200,000 house and a $100,000 loan. So you'll have $100,000 of equity in each one of the examples. We'll walk through to compare and contrast each. But I just want to point out nothing we're going to go over today is specific investment advice. You should always seek counsel when going through your specific situation and which one of these is right for you. But the goal here today is just to give you a fundamental understanding of which each one of them can do and kind of the pros and cons with each approach. So I hope that's helpful. We'll kind of talk through this in a compare and contrast dialogue. But the main point is if you have equity sitting out there, it really doesn't do you any good if you're not able to leverage it in some capacity. So if you had $100,000 just sitting in a savings account, most people wouldn't hold that in cash. Most investors are trying to get a return on that money, and most people would agree that cash loses money every year due to inflation. So why do most people leave their equity sit out in the home or leave a paid off home sit there and not leverage that in some fashion? So these are two ways to go about doing that. So we'll start off first with the cash out refinance. So a cash out refinance is basically a new loan that wipes out the current loan and is typically for a higher amount. So in the example here, where you have the $200,000 home, you owe $100,000. Let's say you want to, buy an investment property. This is a good reason why you might want to consider one of these approaches. So when you go to the bank, you find out that you can get a loan for up to $160,000. That's 80% LTV, loan to value, on a $200,000 appraised house. So let's assume that you want to go get a new loan for $160,000. Sorry, a little dyslexia there. So when you go to do that, what basically happens, sorry, not accurate, they cross this loan out and they start a brand new loan at this amount of $160,000. And now when they go to cross this out, essentially what they're doing is paying that off. So they'll pay this $100,000 loan off that existing note. They'll give you this new one, and then since they only needed $100,000 of this to pay that off, you get the other $60,000 in the form of a check at closing. So and then your mortgage balance would then become $160,000, and then from then on you would pay monthly payments based on a loan amount of $160,000. So obviously your monthly payments will increase when you take cash out, but you will get this in the form of liquid cash in a check that you can go do something with it. Yeah, the big thing there is that it does wipe out the existing note and create a brand new one in its place. And that's different from the HELOC. Okay, so the HELOC, we're in the exact same starting position, $200,000, we owe $100,000. In the same situation, a HELOC will let you go up to 80% LTV for most cases. Sometimes if this was an investment property, they may be in the 70 to 75% range, but nonetheless, we're going to do the same thing. We want to tap into this $60,000 we have sitting out there. So what a HELOC does, instead of canceling out this $100,000 loan, it effectively creates a new option here. So this will be a $60,000 line of credit, and you would still continue to make your normal monthly payments on the $100,000 loan. Nothing changes there, but it does record a second lien against your property for the amount of $60,000. And now what you can do with this amount, this isn't a check that's just written to you like the one over here. This is in the form essentially of credit, just like you would use a credit card. So if someone gave you a credit card with a limit of $60,000, it's effectively the same way. Now, most of the times with the HELOC, you're able to just transfer that balance into an actual account that you can write checks out of. So it could be very similar in that instance, but the key difference here is now with a cash out refinance, you're making monthly payments based on this amount. So basically every month you're paying for the benefit of having access to the $60,000. Where in a HELOC, since you just have this available if you need it, you're really only paying when you use it. So for example, we find an investment property for $60,000 and we want to pay cash for it. We can transfer this $60,000 into an account that we can write checks out of, wire money from, etc. And once we transfer that out, then you start to pay monthly interest-only payments on that $60,000 that you're using, or maybe you only need $20,000. But in that case, you would only pay for the amount you're using. So that's a huge benefit of the HELOC, is that you're not paying for an amount that you potentially might not even need, and you're not forced to use it unless you truly need it. So those are kind of the fundamental differences at a high level, comparing and contrasting the two, where one is a brand new lien on the property. The HELOC keeps the existing lien, it creates a second lien on the property. So all that really means is if you go to sell this for $200,000, you're going to have to make sure that both of these liens are satisfied or paid off before they can actually transfer title. So nothing impactful with either one of these, but you want to make sure that you kind of think through how you're going to use the money when you really need it before you decide kind of what approach might be better for you. So the pro here with the cash out refinance is you're locking in that full amount into a fixed interest rate and term duration that you'll be able to pay it back on. So with interest rates being historically low right now, if you want to lock in this new amount at a very low rate and for another 30 years, that might be a reason to want to go this route. With the con being, if you don't truly need this $60,000 or whatever amount of equity you decide to pull out in the form of cash, then you're essentially paying for that in monthly payments when you might not need to. Where in the HELOC, you're only paying for what you need, but this 60 grand is sitting out here in a line of credit that when things get ugly, the banks could pull back on. So this is formally locked in place for 30-year duration. Most of these are given for 10 years or so, but I know back in 2008, a lot of banks said, whoa, we're taking on a lot of risk. We're trying to pull back and can be conservative, so we're going to cancel these lines of credit that you don't have used already. Anything you have out there, you can still make your payments on, but we're not letting you take any additional funds out. So that always is a risk, but you really just want to weigh that out before you formally make your decision. Another thing I want to call out with either one of these approaches is please consult with someone who, before you do this, who might be able to provide some investment perspective. Just because the market has appreciated and now you're sitting on $100,000 of equity, you don't necessarily need to go out and buy a new boat or a brand new car, and that's not a good reason to do either one of these. But just want to make sure that you fully think through this before you take out a significant chunk of money that you're not able to pay back or you might get behind on. So a lot of people leverage these tools to do very powerful things. Especially in the real estate investment community, there's a lot of ways to re-leverage your debt and take advantage of market opportunities, investment opportunities, or just restructuring for better cash flow. So I'd be more than happy to talk to you about your house and your specific situation and which one of these may be right depending on what your goals are. But I hope this at least gives you a fundamental approach on kind of what your options are and how to weigh through that decision-making process. If this video was helpful at all, I'd really appreciate a like or subscribe on it. That just shows YouTube that it is worth watching and someone else might be able to benefit from it. So if you have other thoughts or questions, please drop them in the comments below. I do try to answer any comment on any one of my videos, so would really appreciate that as well. Also, if you know someone who might be thinking through this situation, I would appreciate you sharing it with them as well. But as always, Tyler Wehrung with Keller Williams. We'll catch you next time.